Welcome to the Drill Down, in-depth answers to oilfield questions. I'm John Spears.
And I'm Richard Spears.
So Rich, a couple weeks ago, we talked about the state of financial performance of oil companies. And
it was shocking.
It was shocking. And I want to sort of now talk about oilfield service firms. But I also want to tell folks that before we're done, you're going to give us yet another puzzler, right?
I have what has maybe been my all-time favorite puzzler.
Oh boy.
And it will be at the end.
At the end here, okay. But yeah, before we get there, I want to talk about oilfield service companies. So again, the notion being that the industry is going to have to self-finance. And this is not only for oil companies, but oilfield service firms. So we need to better understand what their capital structures are, what their margins are, how they're using their capital, so on and so forth, how much reliance they have for public markets and so forth. So we're now tracking 32 different publicly traded oilfield service firms, land and offshore contract drillers and the like, in order to give us a sense of what those what's happening out there.
And now just to be clear,
Sure.
our firm tracks hundreds and hundreds and hundreds
Yes.
of public and private oilfield service companies.
That's right, yes.
But for this exercise,
Right.
you've picked 32 of them.
Right.
Like,
And-
what would be an example company?
Well, of course, we get the big ones, so Schlumberger, Halliburton, and so forth. But go on down the list as well. Collectively, the group represents 53% of the revenues that the industry received in 2020.
So even, yeah, right. And because that's what surprises people, that
Yeah.
there's thousands,
Oh, gosh, yes.
maybe 10,000s of oilfield service companies,
Right.
but this 30-ish cohort,
are
it represents half of it.
half the revenues, right? So a good sense of then sort of where things stand with regard to these kind of measures regarding financing and financial performance and whatnot. So, and one of the reasons I think it's interesting to do this is because in Schlumberger's recent Q4 phone call, the one that was held just a couple of weeks ago, they had talked about that they had returned to their 2019 level of profitability in the fourth quarter. And
okay, now that by itself was pretty awesome, but it was the context.
the context was that Schlumberger had been signaling to investors that it was going to take them probably till the end of 2021 for that to happen. And yet they basically got there in the fourth quarter of 2020, roughly 12 months ahead of schedule.
A year early.
Yeah, right-o. So that gets you thinking, well, is it just something in their cooking, or is it
Schlumberger just that good?
they're just that good? Is the industry as a whole getting there as well? That kind of thing. So so you got to dive into what these records look like. So again, I've got some numbers that look at the changes in revenue, cash flow from operations, and capital spending for fiscal year 2020.
Okay, let me repeat that.
Revenues, yep.
Cash flow from operations.
And capital spending.
And
yeah.
CapEx. All right.
Okay, so for these 32 companies we look at, revenues were down 27% last year.
Okay.
Kind of what we might have expected. Cash flow from operations was down 29%, so pretty much right in line.
Okay.
And capital spending, their capital spending,
zero.
Well, it was down 50%.
Okay, it's down a lot.
Yeah, it was half of their capital spending took place in Q1, and then it dropped off the cliff.
And why would there be any CapEx if you've got all this idle equipment sitting around?
Yeah.
So it just makes sense.
It was
CapEx
de minimis,
is going to be
absolutely de
pretty
minimis.
small.
Yet what was interesting is what the Q4 results are. Now we have to fill in some blanks.
So
here
that was
because
the whole year.
That was the whole year.
But how about just Q4?
Yeah, Q4. And we have to fill in some blanks because not everything's gotten reported yet. But it looks like on a sequential basis. So the change from Q3 to Q4
Okay.
for these oilfield service firms.
Last year?
Of last
Q3
year.
to Q4. Here
Right.
you go.
And
All right, I'm ready.
Revenues up 20%.
Oh, that's pretty good.
Yeah. Cash flow from operations up 65%. Yeah. That's
phenomenal.
Very good. Yeah, but again, coming off
It
of
was
the bottom.
a really small number, right?
And CapEx was a little change, so it was a low number, and it didn't change much in Q4. I've gone ahead and done some projections for what fiscal 2021 might look like for these same companies under a $50 oil price. And so this is back of the envelope stuff as
Because
best.
who cares about last year? It's over. It was a...
There you go. Fond memories. Yes.
Yeah, great.
Anyway, So revenues, I think, are going to be up on the order of 25 to 30%.
For the whole year
For the whole
of
year.
this current year.
Yeah.
Okay. 25 to 30%.
25 to 30%. Cash flow from operations up probably 40%. So again, a lot of costs taken out of the industry, coming off of a low number, so it makes sense that the growth looks especially good. But there's going to be improvement on both those accounts, very much so.
What about CapEx?
CapEx numbers, I think, are probably going to be year over year down at least a third. I think you're just missing that first half of the.
So I got to put a minus 35%.
Yeah, something like that
in there
yeah.
Because again, why spend money on building stuff?
Yes.
Or renewing something?
Right.
If you've got a lot of idle paid for equipment out there.
Righto. So capital spending is normally been, so here's the, again, the way I like to think about capital spending, be it oil companies or oil field service firms, is what is capital spending as a percentage of cash flow from operations? Because again, the notion being that this industry is not going to really be able to rely upon outside financing going forward, if that's the case. So 2017, give you some sense of the numbers.
Okay, we're going to go back to what was a growth year.
Yeah, right, exactly. We're a company adding lots of equipment, whatnot, to meet the increase in demand. CapEx was 70% of cash flow from operations that year.
So I plowed a lot of the cash that I was getting.
Yep, gotcha.
And put it into building new things.
2019, I'll skip forward a couple years.
Okay.
The CapEx number was 55%. Of cash flow from.
Oh, it already scaled back.
It had already scaled back, and by the fourth quarter of last year, 2020, it was probably 35 to 40% of cash flow from operations. So you can see how the industry's really pulled back. Now, the interesting thing then will be, okay, if we're not going to spend money on replacing capital items or adding to capital stock,
what are you going to do with your money?
What are you going to do with it, right? So that goes to the heart of, well, what's the capital structure of oil field? What does the capital structure of oil field service firms
debt
look like? Right. Yes.
What's debt
right.
look like? So, what does the equity piece look like?
And debt for these companies as a whole is about 40% of their capital structure. So their long-term debt is about 40% of their capital structure.
What do you think about that number? Is that big or little?
Well, it's given the cyclicality of this industry,
it's big.
It's a little high. And of course, that's just the average across the sector. There will be those who have unfortunately leveraged themselves way too much, and we see their stories in the bankruptcy.
That got fixed. That is getting fixed.
Yeah, I'm guessing that on a sustainable basis, the industry, the oil field service sector, probably needs to look like a low 30% debt as a form of the capital structure. So I think much of that cash flow that's not being used for capital spending will be returned to debt holders, will be returned to capital, to equity holders and so forth. I think that'll be where the industry goes over the next year and over the subsequent years as well.
It doesn't go to building new rigs, new pump trucks, new reverse circulators.
So it's an interesting picture. The industry is not going to be heavily reliant upon outside financing if it should be able to sustain these kind of profit margins and so forth. I think the interesting question, the question we'll leave ourselves and our audience with today is, will this kind of improved financial performance spur M&A activity in 2021? Will other companies look around and say, now's my time? Because again, the stock market would tell you that it's pretty cheap to buy these companies as a whole. So will improved financial performance, cause some investor types to come back into the industry?
Because the math is already positive.
Yes.
Already right now.
It should be much improved going forward. Absolutely.
So will it attract? Okay. Well, we're long.
we're in. That's exactly right. Now, that's the question. That's one question, but you've got another question for our loyal listeners, right?
This is our third puzzler.
Yes.
So we've already had the inaugural puzzler.
Yeah.
We had the second puzzler, and we gave the answer last week.
This would be three.
This would be the third puzzler. So are you ready? This one's about you.
I'm writing it down.
In these last few years, my brother John has become an avid gardener and is looking forward to harvesting juicy, ripe tomatoes again this summer.
That's right.
But last summer, being an avid oilfield market analyst, he decided to weigh his harvest at the outset. And then again, when he figured out if they had been sun-dried enough, because you were going to make marinara sauce.
I remember that. Yes. Mm-hmm.
So you had to harvest them,
Yes.
and then you had to sun-dry them.
Yes.
So you got the biggest cardboard box that you could find,
Mm-hmm.
and then you proceeded to fill the box to capacity. And then John weighed the box of fresh tomatoes,
Mm-hmm.
and he discovered that he had harvested exactly
Mm-hmm.
100 pounds of tomatoes.
Okay. 100
Freshly harvested tomatoes.
Yeah.
Now, everyone knows
Mm-hmm.
that tomatoes, or as Ronnie, who takes care of our farm,
Maters.
maters. Everyone knows that maters are 99% water
Mm-hmm.
and 1% tomato stuff. You know, like the skin,
I got it.
the seed casings, or whatever's in tomatoes.
Yeah.
So, but 99% of a tomato is water.
Mm-hmm.
So your 100 pounds of tomatoes were 99 pounds of H2O and 1 pound of whatever the other stuff was.
Gotcha. Mm-hmm.
So that's the setup.
Yep.
After a week of drying out the tomatoes in the hot Oklahoma sun,
Yes.
John's tomatoes
Mhm.
were now 98% water.
Oh.
If we reweighed John's tomatoes
Yes.
right then,
Right.
what would the scale read?
Oh boy. So that's the question.
That's the question. And if you think you know the answer
Yes. Uh-huh.
to this week's puzzler,
Yes.
email it to drilldownshow@gmail.com.
That's right.
And from the thousands of correct answers that we get, we will draw one answer at random from there and announce the winner
There you
on
go.
the next podcast.
I'm already finding my tomatoes. Thanks so much. Well, Rich, I'm looking forward to it. Thank you for listening. This has been The Drill Down. I'm John Spears.
And I'm Richard Spears.